All right, welcome to The Explainer. If you're a focused learner trying to cut through all that market noise and get straight to the mechanics of how regional banks are being valued right now, you are exactly where you need to be. Today, we're breaking down M&T Bank's 2026 stock analysis using what I like to call a tug-of-war framework. We'll be looking at the heavy anchors trying to pull this stock down and the balloons trying to lift it right back up.
Okay, let's dive into this. Here's our roadmap for today. We're looking at the disciplined bank premium, valuation and current earnings, key risks to watch, opportunities for growth, and finally, the Wall Street verdict.
So, Section 1, the disciplined bank premium.
You know, in a lot of industries, being called boring is, well, kind of an insult. But in banking, it's actually a massive compliment. Just think about the contrast here. You've got your classic tech compounders, valued entirely on hypergrowth and going viral. And then you have M&T Bank. M&T is a true regional bank compounder. They aren't about going viral. They're all about credit quality, deposit costs, and just absolute strict discipline. Because at the end of the day, the best long-term performers in this sector are simply the ones that survive credit cycles without destroying their capital.
And that resilience is literally built into M&T's DNA. Just look at the history here. They had steady growth in the mid-2000s, survived the absolute chaos of the 2008 financial crisis, and then pushed right through the 2020 to 2023 period, which, let's be honest, completely rocked regional banks. During every single one of these major stress points, M&T's conservative underwriting and relationship banking model really paid off. Now sure, the whole sector still gets repriced whenever liquidity gets tight, but M&T's history proves that having a disciplined, careful balance sheet is absolutely a bank's best defense.
Moving right along to Section 2, valuation and current earnings.
Now what's really interesting about where we are right now is this specific price range, $214 to $222. Because it's trading in this territory, the market is basically saying M&T is no longer distressed. That bottom-of-the-barrel, ultra-conservative valuation, it's in the rearview mirror. Investors are finally giving them credit for stronger profitability. But, and this is a pretty big but, it's not priced as if the cycle is totally risk-free either.
Let's put some numbers to that. In Q1 2026, M&T brought in a net income of $664 million, with diluted earnings per share sitting at $4.13. But the real standout metric here is that net interest income, which is hovering right around $1.75 billion. In plain English, that's the bank's core spread, so the interest they earn on loans minus the interest they pay out on deposits. Seeing an increase here is huge because it shows their core profitability engine is just humming along beautifully.
All right, Section 3, key risks to watch.
Now, closely tied to that net interest income is the net interest margin, or NIM, which is currently sitting at 3.71%. Like we just talked about, this is that spread between the interest earned on loans and the interest paid on deposits. M&T has managed this really well so far with disciplined deposit pricing. But there's a very clear risk here. If loan yields, the money M&T is bringing in, drop faster than deposit costs, the money they're paying out, well, that margin expansion could stall entirely. It's a super delicate balancing act.
And honestly, NIM isn't the only anchor pulling on this stock. We have to talk about these broader sector threats. Commercial real estate exposure is a huge one. Think office spaces, multifamily construction. Even if the actual realized losses end up being totally manageable, just the perception of risk in CRE can cause investors to aggressively punish regional bank stocks. Then, add in deposit cost pressure. Customers today are so much more rate aware, right? They're constantly shifting their cash into higher yield money market funds. Plus, we're seeing rising credit provisions. M&T actually had to set aside $140 million for credit losses in Q1 2026 alone. Toss in the potential for slower loan growth if the economy softens and increased banking regulations tying up capital. And yeah, you can see exactly why the market is keeping its guard up.
Which brings us to Section 4, opportunities for growth.
So what about the balloons? What's pulling on the other side of the rope to lift M&T up? Well, the biggest one is their massive projected earning base. They've got a full-year net interest income outlook of $7.2 to $7.35 billion. And how exactly do they pull that off? It all comes down to relationship banking and keeping a strict lid on deposit costs. Those are M&T's absolute secret weapons. If they can keep their relationship customers happy without having to overpay for funding, they can protect their profitability way better than banks that have to rely on expensive wholesale funding.
And their strategy brilliantly illustrates how they actually do it. It's a remarkably straightforward 4-step blueprint. Step 1, protect those low-cost deposits. Step 2, maintain that net interest margin we just broke down. Step 3, grow loans carefully, meaning profitable growth with acceptable risk, not just reckless lending. And step 4, expand fee income. Actually, let's zoom in on that fourth step for a second because expanding fee income is absolutely crucial. M&T has been aggressively building out its trust, wealth management, and mortgage banking services, and since they already have such a dominant franchise presence in the Northeast and Mid-Atlantic, this is a very smart play. Why? Because growing these fee-based categories diversifies their earnings. It means they're no longer completely dependent on just that spread income. It's a fantastic buffer.
Finally, let's wrap up with Section 5, the Wall Street verdict.
The analyst ratings right now tell a genuinely fascinating story. We're looking at one strong buy, 5 buys, 1 sell, and a massive chunk of 13 hold ratings. And that block of 13 holds, that is the real message from Wall Street here. It tells us that analysts deeply respect the bank. I mean, there are practically 0 sell ratings, but they also feel like the easy recovery money has probably already been made. At these current prices, nobody is treating the stock like an obvious table-pounding bargain anymore.
So the crucial point is this. M&T is undeniably a high-quality regional bank, but the stock is now much more about execution than it is about recovery. The whole narrative is shifted. It's not about just surviving a sector reset or bouncing back from distress anymore. To actually see further upside from here, M&T has to actively execute on that growth blueprint. They have to prove quarter after quarter that they can control deposit costs, maintain pristine credit quality, and organically grow the business.
Which leaves us with this final question. We know M&T Bank has an incredible legacy of surviving turbulent times simply by playing it safe and smart. But is that historic discipline going to be enough to justify further upside in today's highly volatile credit environment? Or is the easy money truly off the table? It's a fascinating tug of war between execution and economic pressure, and it's definitely a dynamic you'll want to watch closely. Thanks so much for joining me for this explainer. Keep learning, and I will catch you next time.